Are you prepared for an economic crash? According to renowned financial expert Robert Kiyosaki, it's not a matter of if, but when. You may know him as the author of Rich Dad, Poor Dad and an expert in financial literacy. In this eye-opening video, Kiyosaki unveils his predictions along with practical steps you can take right now to protect your wealth and seize incredible opportunities that arise during times of crisis. Despite non-urgent signs of recession, Kiyosaki made an alarmist tweet recently, suggesting that stock market fluctuations may herald not just a recession, but a depression. He tweeted, "I do not play the stock or bond markets. As an entrepreneur, I like my hands-on control too much. Yet too many signs point to a severe stock market crash. If your future depends on stocks and bonds, please be careful. Possibly ask for professional advice. Afraid depression is coming." In this video, we'll delve into Kiyosaki's prediction and share essential tips to help you safeguard your finances during uncertain times. So let's get into it. Understanding economic crashes. But first, what exactly is an economic crash? Well, an economic crash, also known as an economic collapse, is a sudden and severe decline in economic activity that can have far-reaching consequences. It typically involves a significant drop in gross domestic product or GDP, widespread job losses, a sharp decline in corporate investment, and often leads to a significant downturn in financial markets. An economic crash can happen due to various factors, including financial crisis, macroeconomic imbalances, and poor fiscal and monetary policy decisions. Such crashes are usually expressed during recessions and depressions, which are both characterized by economic decline, but they differ in terms of severity and duration. Kiyosaki also highlights the differences between recessions and depressions, which are often used interchangeably but have distinct characteristics. A recession is a milder economic decline, typically defined as a period of at least 2 consecutive quarters of negative GDP growth, lasting around 6 months or more. During a recession, there may be an increase in unemployment rates, reduced consumer spending, and decreased business investments. In contrast, depressions are more severe and long-lasting economic slumps. Kiyosaki points out that depressions are characterized by prolonged high unemployment, sharp declines in GDP, bank failures, and widespread asset price deflation. It's crucial to recognize these distinctions, as the severity of an economic crisis can significantly impact your financial well-being. To prepare for economic crashes, it's essential to learn from history. The United States has witnessed several significant economic downturns. As highlighted by Robert Kiyosaki, the United States has experienced several significant economic downturns throughout its history. One of the most notable is the Great Depression, which began in 1929 and lasted until the late 1930s. It was characterized by widespread unemployment, a severe decline in GDP, and a collapse of the stock market. The government implemented various policies and programs, including the New Deal, to help the country recover. Another notable downturn is the Great Recession, which occurred from 2007 to 2009. The Great Recession of 2008, triggered by the housing market collapse and the ensuing global financial crisis, stands out. It resulted in massive job losses, foreclosures, and a severe housing market crash. Kiyosaki's insights stress that understanding the causes and consequences of such events can help individuals and businesses make informed decisions during turbulent economic times. Another historical example is the early 1980s recession in the US. It was marked by high inflation rates, unemployment, and a severe economic downturn. The Federal Reserve implemented stringent monetary policies to combat inflation, which, as Kiyosaki notes, had a significant impact on the economy. Lastly, the COVID-19 pandemic in 2020 led to an abrupt and significant economic contraction. Lockdowns and restrictions disrupted various industries, leading to unprecedented stimulus measures implemented by governments worldwide. Factors leading to economic crashes. Financial crises are often the spark that ignites economic crashes. These crises can take various forms, including stock market crashes, asset bubble collapses, or bank failures. These events have a domino effect on the economy, leading to a downward spiral of economic deterioration. One of the key aspects emphasized by financial expert Robert Kiyosaki is the mismanagement of debt and the practice of printing money to solve economic problems. Such actions can contribute to the buildup of financial imbalances that eventually lead to a crisis. Macroeconomic imbalances are another critical factor that can destabilize an economy and lead to a crash. These imbalances can manifest as excessive debt levels, inflationary pressures, or trade deficits. Robert Kiyosaki has consistently pointed out the dangers of such imbalances in his predictions of an impending economic crisis. When an economy becomes burdened by unsustainable levels of debt or faces inflation that erodes the value of its currency, it is at risk of entering a recession or even a depression. The impact of fiscal and monetary policies cannot be understated in the context of economic crashes. Inadequate government responses to economic challenges or the mismanagement of central bank policies can exacerbate crisis. Robert Kiyosaki's concerns regarding government actions such as excessive money printing resonate with this aspect. When policymakers fail to implement effective measures such as regulating money supply or controlling inflation, it can lead to economic turmoil. Current state of the economy. Economic indicators such as inflation, GDP growth, and the cost of living play a crucial role in assessing the current state of the economy. Robert Kiyosaki's recent warning about a potential economic crash has ignited concerns among many. Inflation, which measures the increase in prices over time, has been on the rise, causing concerns about its impact on consumers' purchasing power. In addition, while the GDP has been expanding, it's essential to note that the rate of growth is slower than expected, indicating potential economic instability. The rising cost of living from housing to basic necessities has placed a strain on households, affecting their overall financial health and creating a sense of uncertainty about the future. Despite some optimistic economic outlooks, concerns persist about the current state of the economy. Robert Kiyosaki's cautionary statements about a possible recession have raised questions about the resilience of the financial markets. While unemployment remains historically low, there is ongoing oppression about how higher interest rates, as predicted by Kiyosaki, may affect consumer spending, a major driver of the US economy. Economic growth, though positive, is slower than anticipated, fueling doubts about the sustainability of this economic expansion. Beyond domestic economic factors, external influences can significantly impact the current state of the economy. Geopolitical tensions such as the Russia-Ukraine conflict and persistently high oil prices have the potential to disrupt global trade and financial stability. As the world becomes increasingly interconnected, events in one region can have far-reaching consequences, affecting markets, business operations, and consumer confidence worldwide. Impact of Kiyosaki's predictions. Robert Kiyosaki's May 2021 prediction regarding the Federal Reserve raising interest rates to combat inflation has had notable consequences in the financial world. Kiyosaki's foresight about this event indeed came to pass, and it triggered a series of reactions across various asset classes. The most immediate impact was seen in stocks, where the cost of corporate loans began to rise as interest rates increased. This in turn led to concerns about higher borrowing costs affecting business profitability, causing stock values to drop. One of the key aspects of Kiyosaki's prediction was the effect of rising interest rates on different asset classes. Beyond stocks, his forecast extended to bonds, real estate, and gold. As interest rates increase, newly issued bonds typically yield higher returns, while existing bonds with lower yields can lose their allure to investors. This scenario led to a decline in bond prices, illustrating the interconnectedness of interest rates and financial assets. Moreover, rising interest rates can directly impact real estate deals, making housing less affordable and diminishing demand, ultimately lowering real estate prices. Preparing for economic uncertainty. Economic uncertainty can strike at any time, and it's essential to be prepared. One of the first steps toward financial resilience is building an emergency fund. As Robert Kiyosaki wisely suggests, Having a financial cushion that can cover 3 to 6 months' worth of living expenses can act as a safety net during tough times. This fund provides peace of mind and ensures that you can meet your basic needs even if you face unexpected financial challenges. Diversifying your investments is another crucial strategy to weather economic storms. Spread your investments across various asset classes such as stocks, bonds, real estate, and more to reduce risk. Kiyosaki's insights into the potential volatility of these asset classes highlight the importance of not putting all your eggs in one basket. Regularly reviewing and rebalancing your investment portfolio to align with your financial goals and risk tolerance is essential. Managing and reducing debt is a fundamental part of preparing for economic uncertainty. Prioritize paying off high-interest debts first and avoid taking on additional loans during turbulent times. Reducing your debt burden not only alleviates financial stress but also provides you with more financial flexibility to navigate economic challenges. Budget planning and spending control are indispensable in uncertain times. Create a budget that tracks your income and expenses meticulously. Identify areas where discretionary spending can be trimmed and allocate more funds towards savings and debt repayment. A well-thought-out budget serves as a financial roadmap, helping you make informed decisions about your financial priorities. Reviewing and adjusting insurance coverage is often overlooked but can be a critical aspect of financial preparedness. Assess your insurance policies including health, life, home, and auto insurance to ensure they adequately protect your assets and well-being. Adequate insurance coverage can provide valuable financial protection in the event of unexpected events. Exploring additional income streams is a proactive way to enhance your financial stability. Consider side businesses, part-time gigs, or investments that can diversify your income sources. Having multiple streams of income can provide added protection during economic downturns. Lastly, staying informed about economic developments and trends is an ongoing responsibility. Continuously monitor economic indicators, business trends, and market performance. This knowledge empowers you to make well-informed decisions and, if necessary, adapt your financial plans to align with changing economic conditions. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.